Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. Well, a lot of us are befuddled with the reaction of the asset classes, not so much over the last 12 months. I think everybody's now come to terms with the fact that markets don't need to move in opposite directions every time cases rise. But we're seeing a rise of yet another wave across the world. And we're seeing yields move in a direction quite contrary to what the street expected the yields to move, especially the US yields. So lots happening on the world stage, which is a bit counterintuitive, if you will, to make sense of all of this and the impact of what it can, impact of this on the emerging market pack, the Asian pack in particular, and India as well. Joining us now is Mark Mathews. He's head of research Asia at Julius Baer. Mark, so good having you. Thanks much for joining in. Hope all is safe.
Yes, I'm very well. Thank you, Niraj. I hope you are too.
Touchwood, all okay, Mark. So, Mark, let's kind of let me throw this open question to you. What do you make of the current developments? Because we're seeing the virus scare re-emerge in China, of all places, as well. In the US, it's moving up in a big way, and we're seeing the plateauing of the drop in cases that we were seeing in India as well.
I think that Israel is showing us that you need more than 60% of your population fully vaccinated to truly move into a endemic stage, away from an epidemic stage. In other words, it's always bubbling away, but manageable. So I suppose that we can get there. It's just going to take time. And what I sense is that governments have moved from a carrot to a stick. And so now you're seeing in many, many countries rules coming into place where you can't go to a restaurant unless you're vaccinated. You won't get paid if you're a healthcare worker unless you're vaccinated. And the governments have to toe this fine line between not scaring people so much that they won't go out and consume anymore, but scaring them enough that they'll go and get vaccinated. And it's a fine line to walk, but seems to be working. I mean, I think it was middle of last month, French President Macron said just what I told you now: healthcare workers, if you're not vaccinated, you're not going to get paid. Well, in the next week, 1 million of them signed up for vaccines. So there will be holdouts, but I think that generally we can say it's moving in the right direction. And moving in the right direction in emerging markets too. Clearly, India among them, terribly hit by Delta, not vaccinated enough, and Southeast Asia, Africa, Latin America grappling with this terrible issue. But I think over the course of the next few months, they will, and one after another, kind of get there, get to where India is now, and then some. And so I think the move's in the right direction, and that's what I would say about COVID.
Yeah, no, but what I meant was, how do you believe the investment world reacts to this? Yeah, because it now seems that the markets world over, or investment world, the world over, are taking into stride that yes, there will be these cases that will flare up. So do you think this flare up that we're seeing right now will have an impact on markets which everyone complains are at extremely stretched valuations, or are they?
It is having an impact on markets, but it's strange. The old saying, sometimes bad news is good news. So actually the COVID impact is positive on markets, because markets are now thinking that governments and central banks will remain looser and more generous for longer. And I think it's one of the major reasons that explains the 10-year back below 1.2%. So actually, I think the COVID situation on the whole is probably supporting markets, as strange as it might sound. And as for the valuations, of course, they're expensive in historical terms, but relative to bond yields, equity markets are not expensive, and it depends which way you want to look at them. Probably want to take a little bit of both. And so if you do that, then the expensiveness in historical terms kind of gets canceled out by the cheapness relative to the bond market. And I would suggest, therefore, they can at least trade sideways. And then if you do get earnings coming in, they would re-rate on the basis of that over time.
Okay. What about yields, Mark? And what are they saying at a point of time when everybody's talking about higher inflation being a near certainty? We're seeing the yields cool off yet again.
Yes, a great contradiction in the bond market. I think we just have to live with this strange situation where inflation indicators are high and bond yields are low. And why is that? One reason is just to go back what I said earlier. The governments and central banks are having to send out slightly contradictory messages which befuddle the markets. On the one hand, they're saying, get vaccinated, otherwise you could get sick and die. And on the other hand, they're saying, don't worry, things are okay, go out and, sort of shop so you can support the economy. And I think they're managing that well, but it does make the market confused. Now, the other thing I would point out is the big reopening in the West has happened. And the purchasing managers indices have peaked. This is what we're seeing in the July data. And so historically, PMIs lead the economy. They do. You can look at any chart and you see the PMI and the GDP fit very well together. But the PMIs are reported well before the GDPs are. So I guess what I'm trying to say is we've got a very good indication that the month of July is, or was, I should say, because now we're in August, the peak for economic activity in the United States, most importantly, because we're talking about the Treasury yield. And it will also be the peak for earnings because PMIs historically, perhaps I should say not aggregate earnings, but earnings upgrades. PMIs have been an excellent leading indicator for earnings upgrades. And so and you put those on top of it, that we probably did reach some kind of economic growth peak last month, then that could also help explain why yields have come down lower.
Just one quick follow-up, Mark, on this whole inflation argument, the commodity price inflation, that commodity prices uptick-led inflation that we're seeing. But if indeed the virus scares keep on re-emerging, do you reckon it's the supply side getting disrupted which will lead to further escalation in prices? Or do you think that weak demand will kind of cap potential upsides now that there has been a really sharp rally in commodity prices already?
Well, that's a great question. It's a mixture of both. So we're already seeing a decline in demand for new housing in America, for example, because the price of property's gone up a lot. But we're also seeing continued capacity constraints, as you rightly point out, because of supply chain disruptions due to COVID. And the high property prices, for example, that's something that will probably naturally cap itself out. I mean, I don't think, people reach a certain point, they just can't pay anymore. They can't afford to buy that property. But with the other things that are being encumbered by the supply chain disruption, that can be resolved over time as the supply chain improves itself, as the world vaccinations continue to ramp up. And so probably what we are seeing is a bit of the consumption that should have happened in 2021 is now going to be pushed into 2022 due to the lack of supply of certain products. But I do think it will be there in 2022. So it'll actually just end up bumping up growth for 2022.
Okay. Mark, put all of this in and juxtapose this with how do you expect the Asian space to do? Because we are still battling, forget a defeating of the COVID cases and then a resurgence. We just have never gotten out of it. Most of Asia, at least, if not all. How do you look at the Asian screen vis-a-vis the West?
Well, there's a few things to say. The first thing I'd say is that I do think interest rates are artificially low and will move higher. So we do expect the 10-year Treasury to be at 1.8 in 3 months and 2.1 in 12 months. That's not enough to upset the apple cart, but it does mean that yields won't be so incredibly low as they are now. And then the second thing is what's going on in China, which is, of course, a major U-turn in policy toward private enterprise. And it's interesting because on a personal level, most people would agree, yes, children shouldn't play so many video games and people shouldn't buy so much junk online and etc. But it's hurting the market because those technology consumer giants in China became such a big part of that market. So in Asia, I think what's happening in China actually will give the rest of Asia some more what do you call that? It'll feature more prominently than it did before because it had really been eclipsed. Large parts of Asia had been eclipsed by China, Southeast Asia, for example, and Korea, Taiwan. So they'll have more space, more place on the bandwidth. And India, I think, will also, in relative terms, become more interesting to people who are searching for alternatives. Then there'll be some people, I must say, who will take a lesson out of the China story. That is, you just shouldn't be invested in emerging markets because if there's not a good rule of law, this is what happens, and don't respect private entrepreneurship, et cetera, et cetera. And people who don't know enough about Asia would say, well, they're all the same, which of course they're not. So some people, I think, will say it's time to go back to safety, which is U.S. stocks. Indeed, the flow seems to be that way right now. The selling of the big Chinese ADRs in America. The money's going into the FANGs, actually. It's not going into India. But as the dust settles, I think people will be looking for alternatives. You don't want to have all your portfolio in America. By all means, have most of it, but not all. And so I think Asia, ex-China, will actually achieve more prominence going forward.
Mark, my conversations with companies, because we're in the results season, seems to indicate a lot of these are now starting to see definitive tailwinds of the China plus one strategy that everybody was talking about 12 months ago. Everybody was saying that the narrative is there. Now companies are then saying that it's actually turning out to be true. Textiles, because of the US and the Xinjiang ban and all of that, or the PLI-led moves that have happened in manufacturing for India, or specialty chemicals or pharmaceuticals. All of these are saying that they are now seeing customers coming in who were previously in a large portion going to China. So my question is the best behind us, or do you believe this China plus one narrative, the best is still yet to come for the Asian region?
I don't know how to answer that because surely there's more left on the table in terms of people wanting to reallocate to India and other countries in Asia. But how much has already been done, I honestly can't say. But I would say that we are in a world which is being divided essentially between certainly China, one block, and then the US is another block. And then where everybody else falls in between really depends on each country. But I suspect that the US block would be the larger one. And countries that are part of that, and I think India is part of that, would therefore benefit from this, bifurcation of the global economy.
Okay, Mark, then let me try and keep it simple. Some of these things are difficult to say. Let me ask for your view on India. We had a big pull up yesterday and we are at record highs. Earnings are nowhere close to that, and we are still battling the COVID wave and therefore the reopening of the economy. What's your sense about what happens to the Indian markets over the near term and over the slightly medium term as we hit what we typically call the festive season, wherein consumer demand typically tends to move up?
Well, Niraj, I don't know if I can comment on the near term, but if I was, I would just say I like India, and there's several reasons. So the first is that you just said there was a breakout yesterday on the NIFTY, which is very obvious. It had just been going sideways and a big breakup. So technically, the chart looks good. it has been a big laggard over the last 5 years to MSCI World, certainly to the World Index. And I think that's going to change because some of the things that were causing it to lag are changing, namely earnings growth is going to be very robust this year and next year, we think. And I do believe that out of every crisis comes an opportunity. And I sense in India a strong dynamic of wanting to come back from COVID, and so with COVID itself, it's a big problem in India. It's a big problem everywhere in the world. I think the vaccination progress is very material. You should get, I think, at least to 60% fully vaccinated by the end of the year. Which is not enough to call it endemic. As I said, you really need to get it above 80%. In fact, I don't remember which authority in America said last night that they actually feel it should be close to 90% anyway.
Yeah, for the Delta variant, yes.
Infectious Diseases Society of America. In India, there's a lot of herd immunity already. So, COVID is a problem, but it's a problem everywhere. I think in some ways India may be a bit more advanced than the others, simply because it had the big second wave, and the vaccine rollout has been pretty strong. And then I also think that you have a healthy pipeline of new economy companies coming up. The first was Zomato, but it won't be the last, Swiggy and lots of others, that will add an interesting dimension to the market that it has lacked, and that will put it on the radar screen of many investors who otherwise wouldn't look at it. Those are just some things, really. But the overarching theme for India, longer term, for us, is the demographic profile, where it's in this sweet spot, you'd call it, where the working age population is larger than the dependent population. That will remain the case until approximately 2060. And there are other countries in the world that are in that sweet spot, but they're not really investable. Like if I said, no offense to Bangladesh or Pakistan, they're very interesting, but they're hard to invest in, whereas India is quite easy to invest in, lots of ETFs and ADRs, etc.
Awesome. Mark, I wanted to wrap up our conversation with that very point that you mentioned, which is the new companies coming in. It's a new set of companies for the Indian diaspora, Indian people, if not for seasoned investors like you who look at across the world and have looked at these companies. But it's also promising to be a year of IPOs of a mammoth proportion after what was already a fairly strong primary issuance year, which is FY21. Do you reckon that there will be a healthy appetite for these consumer tech firms coming out of India? Because the reason I ask this question to you is because the common narrative is that, if China is clamping down there, it's a great thing for India. It surely can't be as simple, right? What's your sense of what happens to some of these?
I think it is that simple, actually. I think that, the lion's share of these companies are listed in the West, in America specifically. You don't have many in Europe. And wherever else you can find them, it will make that place look interesting, because people are looking to invest in the digitalization of the economy, but they don't really want to have all their eggs in one basket. And so I think it's an incredibly important thing. And I think it'll, as I said earlier, really put India on the radar screen for a very large universe of investors who would not have otherwise bothered to look at it.
Okay, Mark, that's a vote of confidence for some of the companies looking to come out as well. But really appreciate you taking the time out and speaking to us today. And really look forward to having more often. Your opinion is very, very welcome. Thank you so much.
Not at all. Thank you, Niraj. Bye-bye.
Bye-bye. And viewers, thanks for tuning into this edition of The Talking Point.